Most seniors haven't heard about this new 2026 IRS rule, and that could turn out to be a very expensive mistake. Right now, there's a major change quietly coming that could put thousands of dollars back into the pockets of retirees, and almost no one is talking about it. This isn't a small adjustment or a routine yearly update. It's a brand new opportunity written directly into the tax code that could dramatically lower how much you owe to the IRS over the next several years. And here's what makes this so important. If you're 65 or older, you could be eligible for an additional deduction worth up to $6,000 as an individual, or as much as $12,000 for married couples filing jointly. That's real money that could stay in your bank account instead of going to the government. But there's a catch. This rule is temporary, it has income limits, and it only applies for a short window of time. Miss it, and the opportunity is gone. Over the next few minutes, I'm going to break this down step by step in plain, simple language so you know exactly what this rule is, how it works, who qualifies, and what you need to do to actually claim it. Because if you qualify and don't claim it, you could literally be leaving thousands of dollars on the table without even realizing it. Quick disclaimer before we start. I'm not the IRS and I'm not your personal tax advisor. Tax rules can change and everyone's situation is different. This video is here to inform and educate, not to replace advice from a qualified professional. Always double check any tax decision with the official IRS website or a trusted CPA, enrolled agent, or tax professional. With that said, let's get into it. Who I am and why this matters for you. Hi, I'm Sofia. If you've ever felt confused, overwhelmed, or frustrated trying to understand taxes in retirement, you are absolutely not alone. The tax system was not designed to be simple, and it can feel especially complicated once you stop working and start living off Social Security, pensions, or your savings. My goal is to help seniors like you make sense of complicated financial rules, cut through the jargon, and turn it into clear, practical information you can actually use in real life. And today, we're talking about something that could have a very real impact on your retirement income over the next 4 years. Most tax changes that get announced every year are small. They might adjust a bracket or tweak a credit, but they don't really change your day-to-day life. This one is different. This new benefit was designed specifically to give older Americans extra financial breathing room at a time when living costs keep going up, medical expenses are rising, and retirement savings have to last longer than ever. Big picture, what exactly changed? So, what is this new rule? The IRS introduced a completely new additional tax deduction aimed specifically at people who are 65 and older. It's being called the senior bonus deduction, and it's unlike almost anything we've seen before. Here's why it's so powerful. Normally, when a new tax benefit comes along, you have to give something up. You choose between one credit or another, or you take either the standard deduction or itemized deductions, or you lose one benefit if you qualify for a different one. This one doesn't work that way. This deduction stacks on top of everything you're already entitled to. That means you keep your regular standard deduction. You keep the extra deduction you already get for being over 65. And now you add this brand new amount on top of both of those. Think of it like building blocks. First block, your basic standard deduction. Second block, your age-based senior deduction. Third block, this new senior bonus deduction. Every layer gets added on top of the last one, creating a much bigger shield between your income and the IRS. That stacking effect is what makes this rule so powerful. It was created as part of a broader effort to give financial relief to older Americans who are dealing with rising medical costs, higher housing, food, and utility costs, the challenge of making savings last through a longer retirement. Instead of sending more of your income to the IRS, this rule lets you legally keep more of what you've already earned. And the best part? This isn't some complicated loophole or risky strategy. It's a straightforward, written into the law deduction. And this is crucial, it does nothing for you if you don't know it exists or you don't claim it correctly when you file. That's why so many seniors are at risk of missing out. They simply don't realize this opportunity is sitting there waiting for them. How much is this really worth in dollars? Let's talk numbers because that's what really matters. For single filers age 65 plus, we'll start with single filers who are 65 or older. Under current projections for the 2025 tax year, the regular standard deduction for a single person is expected to be around $1,550. On top of that, seniors already receive an additional age-based deduction of about $2,000 just for being over 65. So even before this new rule, a typical senior might have $15,750 standard deduction, $2,000 age-based senior deduction, $17,750 in deductions. Now, with this new senior bonus deduction, you get to add another $6,000 on top of that. So your total potential deduction becomes roughly $15,750, $2,000, $6,000. $23,750. That means nearly $24,000 of your income could be completely protected from federal income taxes before you owe even a single penny. For many retirees living on Social Security, a small pension, or modest withdrawals from IRAs or 401ks, that can make an enormous difference. For some people, it may even mean going from owing taxes to owing nothing at all. For married couples, 65 plus filing jointly. Now let's look at married couples, because the impact can be even bigger. If both spouses are 65 or older and filing jointly, the standard deduction is projected to be about $29,200. Then each spouse gets an additional age-based deduction, adding roughly $3,200 combined. So before this new rule, a typical senior couple might have $29,200 standard deduction, $3,200 combined senior age-based deduction, $32,400 in deductions. Now comes the new senior bonus deduction. Each spouse could be eligible for $6,000 for a total of $12,000. Add that on top and you get $29,200 or $13,200, $12,000 are $44,400. So a married couple could potentially shield about $44,400 of income from federal taxes. For households trying to stretch retirement savings, that is a huge amount of protection. You don't need anything fancy to qualify. Here's something a lot of people are surprised by. You don't need special investments, complicated trusts, or high-end tax strategies. This is a benefit available to ordinary seniors simply because of their age and their income level. If you qualify, this deduction is just sitting there waiting to be claimed. For many people, it could mean the difference between writing a check to the IRS or keeping that money to pay for medications, food, or utilities. That's why understanding this rule is so important. We're not talking about a few dollars here and there. We're talking about hundreds or even thousands of dollars over the next few years. A unique feature, it works with standard or itemized deductions. Most tax benefits make you choose. Either you take the standard deduction or you itemize things like medical expenses, charitable giving, mortgage interest, and so on. Usually, it's one path or the other. This senior bonus deduction breaks that pattern. It works no matter which option you choose. That means if you keep things simple and always take the standard deduction, you can still claim this new bonus on top. If you're someone who tracks itemized deductions like high medical bills, charitable donations, or property taxes, you can also claim it. There's no penalty and no need to pick one or the other. You don't have to give up itemizing to use this, and you don't have to itemize to get it. This makes the deduction far more accessible, easier to use, and useful for a much larger number of seniors. You don't need to own a home to have a mortgage, or to keep a shoebox full of receipts as long as you meet the age requirement, 65 or older, and fall within the income limits. This deduction is available to you. But there's a clock ticking. This rule expires. Now we need to talk about something very important. The time limit. This deduction is not a permanent part of the tax code. As the law is written right now, this benefit only applies for 4 specific tax years: 2025, 2026, 2027, 2028. After that, unless Congress decides to extend it or make it permanent, the entire benefit disappears. That means you have a 4-year window to take advantage of this opportunity. Once those years are gone, there's no going back and claiming it later. You can't reopen old returns years down the road and ask for the senior bonus deduction if it wasn't in effect for that year. This is why planning ahead matters. Decisions you make about when to take money from your IRA or 401k, whether to work part-time, when to realize investment income over the next few years could affect how much you're able to benefit from this rule. And the time limit isn't the only restriction. Income limits. Who gets the full benefit and who doesn't? This deduction was created mainly to help low and middle income seniors. That means there are income thresholds. Below a certain income, you get the full bonus. Above that level, the deduction starts to phase out. At a higher level, it goes away entirely, but it doesn't disappear all at once. It shrinks gradually, which is actually good news for single filers. If you file as single, you can receive the full $6,000 senior bonus deduction if your income is $75,000 or less. Once your income goes above $75,000, the deduction begins to shrink. By the time your income reaches $175,000, the deduction is completely gone. For married couples filing jointly, if you're married filing jointly, you can receive the full $12,000 deduction if your joint income is $150,000 or less. Above $150,000, it starts to phase out. Once your joint income hits $250,000, the deduction is fully phased out. These limits are crucial because they determine whether you get the full bonus, a partial bonus, or no bonus at all. How the phase-out works with simple examples. The government uses a simple formula to reduce the deduction as your income goes above the threshold. For every $1,000 of income you earn above the starting limit, your bonus deduction is reduced by $60. Let's walk through a couple of examples so you can see it in action. Example 1, single filer. Suppose you're single, 67 years old, and your income for the year is $85,000. The full senior bonus deduction is available up to $75,000. Your income is $10,000 over that limit. For every $1,000 over the limit, you lose $60 of the deduction. $10,000, 1,000, 10x, $60, $600 reduction. So instead of the full $6,000, your deduction would be $6,000, $600, shock $5,400. You still get a substantial deduction, just slightly lower. Example 2, married couple filing jointly. Now imagine a married couple filing jointly, both over 65 with a combined income of $170,000. The full senior bonus deduction is available up to $150,000. Their income is $20,000 over that limit. Again, for every $1,000 above the limit, they lose $60, $20,000, $1,000, 20 onyx, $60, and $200 reduction. So instead of a $12,000 deduction, they would get $12,000, $200, $10,800, still a very meaningful tax break. The key point here is, even if you're over the threshold, you might still qualify for a partial deduction. Don't assume you get nothing just because your income is a little higher. This is especially important for seniors who might be just a bit above those limits. Small planning moves may help you keep more of the deduction. How to actually claim this deduction? Understanding the rule is one thing, using it is another. The good news, the process to claim this deduction is designed to be straightforward. You don't have to hire a very expensive tax advisor just to qualify, fill out dozens of extra forms, or sign up for any special program, but you do have to take action. This deduction is not automatic. The IRS will not apply it for you just because you turned 65. You must actually claim it on your tax return. Here's the basic process based on how things are expected to work. Use the correct tax form. Most seniors will want to use Form 1040-SR, which is a version of the standard tax return tailored for older taxpayers. It has larger print and slightly clearer layout. Indicate your age. On that form, there's a simple checkbox that indicates you are 65 or older. Make sure that box is checked if you qualify. This tells the IRS and your tax software that you're eligible for age-based benefits. Claim the senior bonus deduction. Under the rules as described, this would be done on an additional form. Let's call it Schedule 1A in this script. The actual form number or name could change, so always check current IRS instructions. On that schedule, you'd enter your income and filing status. The form or your software would then calculate how much of the bonus deduction you're entitled to after applying any phase-out transfer, the result to your main tax form. The amount of your senior bonus deduction would then be carried over to your main return, reducing your taxable income. If you use any modern tax software, as long as you put in your date of birth, filing status, and income correctly, the software should handle the calculation automatically once the rule is in effect. If you file on paper or do things by hand, just make sure you read the IRS instructions carefully. Use the most recent year's version of the forms. And don't skip the schedule for the senior bonus deduction. A common myth: this makes Social Security tax-free. Let's clear up a major misunderstanding that's already circulating. You might have heard someone say, this new deduction means your Social Security won't be taxed anymore. That is not accurate. The rules that decide whether your Social Security benefits are taxable are separate and have not fundamentally changed because of this deduction. Those rules are based on your combined income, which includes half of your Social Security benefits, plus other income like wages, pensions, IRA withdrawals, and certain investment income. What this new deduction does do is lower your overall taxable income, and that can sometimes indirectly reduce how much of your Social Security ends up being taxed. For some retirees with modest incomes, the combination of the standard deduction, the existing age-based senior deduction, and this new senior bonus deduction might mean they owe little or no federal income tax overall. But that's not guaranteed for everyone. This deduction is a powerful tool, but it's not a magic switch that makes all retirement income tax-free. That's why it's so important not to make big financial decisions based on rumors or half-true headlines. Always look at your total income picture, filing status, and the official IRS rules for the year you're filing, what this means in real life. Simple, practical examples. Let's put this into everyday terms. Example: single senior. Imagine a single senior, age 70, who qualifies for the full $6,000 bonus deduction and is in the 22% tax bracket. A $6,000 deduction at 22% saves about $1,320 in federal income tax. That's $1,320 that doesn't go to the IRS, stays in your pocket instead. That might cover several months of prescription medications, a winter heating bill, groceries for a couple of months, or a good portion of your property tax bill. Example: married couple. Now picture a married couple, both 68, who qualify for the full $12,000 deduction and are also in the 22% bracket. A $12,000 deduction at 22% saves roughly $140. For many retirees, $2,000, $3,000 per year is a very big deal. That could mean upgrading to better health insurance, visiting grandchildren once a year, catching up on dental or eye care, or simply feeling less stress about month-to-month bills. And don't forget, this deduction can also help if you're still working part-time in retirement, if you're earning a little extra from a side job or seasonal work. The senior bonus deduction can help soften the tax impact of that extra income. Watch out for misinformation and scams. Anytime there's a new tax benefit, especially one targeted at seniors, you can almost guarantee misinformation will start to spread and scammers will see an opportunity. Here are a few important warnings. You do not need to pay special fees to unlock this deduction. There is no secret shortcut, private program, or insider service required. All of the information and forms are free from the IRS. Be especially cautious if someone calls you out of the blue about a new IRS benefit for seniors. They pressure you to act immediately. They ask for your Social Security number, bank information, or a payment up front. The IRS does not call people to demand immediate payment or personal details, does not require you to use any third-party company to claim a deduction. The safest options are use well-known tax software or work with a tax professional you already know and trust, or go directly to irs.gov for official information. Remember, this deduction was created to help seniors, not to give companies a new way to make money off of you. How to think about this in your overall retirement planning. Because this benefit is temporary, your decisions between now and 2028 matter. If you have control over when you take certain types of income, you may want to. Look at how your income each year lines up with the phase-out limits. See if there's a way to keep your income within the range that gives you the most benefit. Some examples of things you might discuss with a professional. Should you spread out IRA or 401k withdrawals more evenly across several years? Should you delay or accelerate certain withdrawals to stay below a threshold? How will part-time work affect your total income during these 4 years? You don't necessarily need to make big, drastic moves, but small adjustments, like timing a withdrawal differently or spreading income over multiple years, might increase how much of the deduction you're able to keep. The key idea is this: now that you know this rule exists, you can be proactive instead of reactive. Many seniors will never hear about it, or they'll hear about it when it's already too late. You are already a step ahead. Final recap and what to do next. Let's quickly summarize the most important points. Age requirement. You must be 65 or older to qualify. Stacking this new senior bonus deduction stacks on top of the standard deduction and the existing age-based senior deduction. Flexibility. You can claim it whether you take the standard deduction or itemize your deductions. Income limits. Single filers get the full benefit up to $75,000 of income. It phases out completely by $175,000. Married couples filing jointly get the full benefit up to $150,000 of income. It phases out completely by $250,000. Phase-out formula. For every $1,000 above the starting limit, the deduction is reduced by $60. Temporary window. It only applies for tax years 2025, 2026, 2027, and 2028, unless the law is changed or extended. Not automatic. You must claim it on your tax return. The IRS won't automatically apply it just because of your age. Not a magic Social Security fix. It does not automatically make Social Security benefits tax-free, but it can lower your overall taxable income. Be cautious of scams. You don't need to pay extra or sign up for a special program. Stick with IRS Gov, trusted software, or reputable tax pros. Now, as you think ahead to your next few tax seasons, ask yourself, do I expect to be 65 or older during 2025-2028? What will my income likely look like in those years? Could this deduction significantly reduce my taxes? Who can I talk to? A spouse, a family member, or a tax professional to help me plan around this? You've spent decades working and saving. Taking advantage of every legal tax break available to you is part of protecting what you've built. So before the clock runs out on this 4-year window, the real question is, what steps are you going to take to make sure you actually benefit from this rule, instead of finding out about it after it's gone? If you'd like more clear, senior-focused explanations on tax and retirement topics, make sure to save this information, share it with a friend who might qualify, and consider talking with a trusted tax professional about how this applies to your personal situation.